Good afternoon, everyone, depending on where you're joining us today. We are going to give it a few minutes to let folks join, and then we'll get started right on time. So thank you all for waiting, and Happy New Year. This is our first webinar, I believe, since the new year. All right, so it is 1 p.m. Eastern, so we're going to go ahead and get started. So good afternoon, everyone, and on behalf of the Environmental Finance Center Network, welcome to our webinar today on financial benchmarking for small water and wastewater systems. My name is Avery Davis from the Syracuse University Environmental Finance Center, and before we begin, we're going to go over a few housekeeping items and we'll get started. During the webinar today, everyone will be kept on mute to ensure audio quality. If you have a question, please type it into the GoToWebinar question dialog box anytime throughout the session. We will be saving your questions for a facilitated Q&A session at the end of the presentation. After the webinar, you will also receive a follow-up email that includes a link to the recording and other information you may need. You can also download the slides from today in the Handouts tab in your GoToWebinar control panel. This webinar has not been submitted for pre-approval of continuing education credits, but eligible attendees will receive a certificate of attendance for their personal record. To be eligible to receive a certificate for this session, you must attend for the entire webinar and register and attend individually using your real name and unique email address. Certificates will be sent via email within 30 days of the webinar date. And if you have a question or need assistance, you can contact us at smallsystems@syr.edu. So now for a little bit about the Environmental Finance Center Network. We provide training and technical assistance to small water and wastewater systems in all U.S. states and territories through our building technical, managerial, and financial capacity programs. If your community or utility needs assistance with drinking water or wastewater system management, please feel free to contact us through our request form, which I will be sharing shortly in the chat. And on that note, I would like to introduce our presenters for today. So we have Kristen Downs and Anna Patterson, who are project directors with the Environmental Finance Center at the University of North Carolina, Chapel Hill. So Anna, Kristen, welcome, and we can go ahead and get started.
All right, well, thank you. I'm Anna Patterson, and I'm going to start off by talking a little bit about enterprise funds. So some enterprises are managed through an enterprise fund. So one common perception or best practice for an enterprise fund is to run it like a business. These are separate from all other funds, and they have their own dedicated revenues with expenses and reserves. So the goal here being that it is self-sufficient and its revenues tend to at least match the expenses in the long term. So you should avoid transfers between the enterprise fund and other funds, and that's often just kind of seen as something to strive for. So when it comes to budgeting for municipal enterprises, you should keep in mind that some of their characteristics and what make them unique to other governmental activities and departments. The first of which, many of these enterprises can be viewed as service industries. So you provide water and electricity for your customers. You pick up their trash and their recycling. You might run a bus system. So enterprises are often providing a service, and where you have a service, you have users. So maybe not everyone in your municipality has access or would use a particular service that you're providing. And you might provide that service outside your municipal limits as well. So the users might not be all of your municipal residents or all of your property owners. So this would affect some of the considerations of who you charge for your service when you set the budget for revenues. These are also production industries. Your municipality might be treating water or wastewater at treatment plants. You'd be generating natural gas and electricity. All of these production costs need to be included in your budget. And it might kind of feel like you're putting together a budget for a manufacturing type business that's being run by your municipality, but really that's okay. Another key characteristic is that there's generally a lot of flexibility on pricing. So there are different ways that you can generate revenue for your enterprises, and Kristen will go over a lot of those later. But going back to the earlier comment about having users for some of the enterprises, there's a lot to consider in terms of pricing and budgeting for revenues that are both fair and equitable. And some public enterprises are actually run as self-regulated monopolies. So if your municipality has a wastewater system, which I think a lot of yours do, is there another wastewater system that runs lines alongside yours? Most of the time that's no. So yours is the only one in town, and the only financial regulation often comes in the form of your council or your governing body, unless there are specific statutes that govern finances for particular enterprises. And many of the enterprises have some element of public health or environmental protection, or for wastewater or stormwater or water. And those are typically regulated for quality, and that has implication for budget expenses as well. And then some of the enterprises are characterized by very high capital cost. You need to think about all of the infrastructure that you own, that you have to maintain and eventually replace in order to run some of your enterprises. So pipes and pumps, your treatment plants, your fleet vehicles, and you should see that reflected in your budgets, and the capital cost should be included, and they could be very high, especially if you've got an older system. But in some enterprises, you might have no capital costs at all. For example, if you contract out your solid waste services, then the municipality might not actually own any of that infrastructure or the costs associated with them. And then just to highlight, often the capital projects are what drive the budget for your water and wastewater systems. Okay, so we've got two types of revenue that we like to cover. The first being your system income. So this is your money from rates, tap fees, system development charges, grants, penalties, and other services or other sources. So, this is what you use to pay your operations and maintenance. And to be a pure enterprise fund, it should be noted that this is not paid from taxes unless that's explicitly permitted by your state. And I know we've got a broad range of participants today, so you'd have to check with your state legislature. And then you've also got debt. So this is your money from bonds and loans, and you take out the debt to pay capital improvement projects, and you have to pay that money back over time. There's 3 types of costs. So your operating costs. This is what you need to run your system day in and day out. So O&M, salaries, benefits, that type of thing. You've also got capital costs. So the rehabilitation and the replacement of your existing infrastructure and the purchase of new infrastructure. And then debt service. So this is what you owe on loans and bonds. So debt service is a type of revenue because that's money that you're taking in, but the debt service is the money that you pay back over time. And then we also have types of reserve funds. So there's capital reserve funds. So these pay for infrastructure, rehabilitation, and replacement. Repair funds. So the repair funds, they pay for known ongoing maintenance issues. And then you've got emergency funds for unknown, unanticipated maintenance issues. It might be a water main break, just something that, is a surprise that suddenly you have to pay for. And then you've got your rainy day fund. So this is kind of a catch-all for unexpected revenue shortfalls. So how much do you need in your reserves? Well, so beyond what's needed for your debt service, it kind of depends. So do you need enough to pay for your most expensive piece of equipment? Do you need enough to cover your O&M costs if you had no revenue for 2 months? So what we recommend is that you have enough in your reserve to cover 2 billing cycles of O&M. So if you bill monthly, then we would recommend you have at minimum 2 months worth of income in your reserves. If you bill biannually, we'd recommend that you have a full year of income in your reserve fund. And that's to cover things like the pandemic, when we had payment moratoriums, maybe you weren't allowed to stop services for non-payers, and suddenly you have a huge budget shortfall. That would be the purpose of having that much money in your reserve for O&M. And then you might also want to think about whether you need enough to cover the projects in your capital improvement plan. And it's different for every community, so you would want to look at your budgets, talk to your your leadership, and figure out how much is necessary for your system. And for those of you who are like me and are visual learners, we've got a graphic here. So your system income, this is the money that you get from your customer base through their bills, and it pays for operating costs, it pays for capital projects, and it goes to pay for debt service. You can also use system income to build up your reserve funds. And then you take on debt to also pay for your big capital projects, the big stuff that maybe you can't afford with just your income from your customer base alone. And then your reserve funds. So the reserves pay for capital projects, they go to pay for your debt service. And then we've got this dotted line for operating costs. And that's because reserve funds can be used for operating costs, but it isn't recommended unless it's an emergency, like the example that I just gave. You really want to keep your reserve funds for emergencies and for, you know, capital improvement. Okay, so financial policies. So you want to think of these as guidelines for your organization's financial, operational, and strategic decision making, and they're often focused on financial stability and the health of your utility, which targets cash management, risk management, debt, investment, revenue, spending, and other things. And these goals can be met with financial policies. You might not have policies in place for all these considerations, but it's always good to set targets. And then transfers to the general fund. So typically, your water and your wastewater system should not be subsidizing the tax base, and the tax base shouldn't be subsidizing your water or your wastewater system. That's not always the case. So, you know, if you receive services from the local government, it might be appropriate for you to pay for those services. So if it's the, you know, the time of the town manager, if you use attorney services, you know, if you exchange employees and you need to pay for payroll, then we do see those transfers on audits that we see from communities that we work with. But typically, you want to be self-sustaining. Budgeting. Okay. So budget should reflect the goal of your governing body. This could be appropriation and allocation of funds, measuring and promoting financial and operational performance, setting rates and fees, and public education. And we'll get a little bit deeper into those metrics and rate setting later. You should check your budget against your actuals monthly, and this will tell you, you know, on a monthly basis if you're budgeting appropriately. And you should think of each budget as a bucket, and, you know, not the whole thing. So you're paying for energy, you're paying for chemicals, salaries, and capital repairs. And by looking at these separately, you can see that, you know, in this example, the capital repair budget is overflowing. Those are really high dollar costs. But you might also see in a different situation, maybe you're paying too much for energy, maybe you're paying too much for chemicals, or, you know, you might need to flex your budget around so that you can have the money you need in a particular place when you need it. So look at all of your costs, and don't forget to look at the sneaky and overlooked costs. So these might be indirect costs of running a system. You know, if you share management costs with another department or with another agency, you might also have shared facility costs. So don't forget about those. It could also be capital related costs. So debt service, if you have taken on debt, don't forget to budget for both the principal and the interest. Depreciation. So this is a big one that we see left off of budgets, and it's very important, and that's why it's highlighted. So depreciation is the reduction of the value of an asset over time. So for example, if you've got an asset that's worth $100,000 and you know that it's got a 10-year lifespan, then you would want to budget $10,000 each year in depreciation costs for that asset, so that after 10 years, when the asset fails, you've got that $100,000 to replace that asset in full. So, you know, if you don't budget for depreciation, you know, you get surprise costs, like big surprise costs when an asset fails and you have to replace it. Overlook costs also include sinking fund transfers and pay-as-you-go capital expenditures. And then don't forget your retirement or your pension plan, insurance for your staff, that type of thing, because those are really important. That's how you retain quality staff, and it's important not to have shortfalls in that department either. Okay, so budgeting for the full cost. So the full cost of your budget is going to include your operations and maintenance, taxes and accounting costs, contracts and contract fees, principal and interest on your long-term debt, contingencies for emergencies, reserves for your capital improvement. So the indirect costs of your fleet, your buildings, keeping the lights on, and shared expenditures with other departments or agencies. Related services, so source water protection, that type of related service. Maybe you've got TMDLs to pay for, whatever you have. Remember to budget for those, and then opportunity costs. You can also use budgeting as a communication tool. So within your utility, think about who's responsible. Who's responsible for the budget? Who's responsible for, communicating that budget with leadership and with the customers? Within your leadership, what are your priorities? So you can use your budget to go to your board or your council and present to them where the shortfalls are. You can show them what the needs are, what you're doing well, highlight the savings that you have. And then with your customers, you can build transparency, and you should be building transparency, because a lot of the time the only communication that you have as a utility with your customer base is their bill. So by budgeting and having bills that are palatable for them, you do build transparency. Okay, so your elected officials, they focus on what their constituents value. So that should be important to you. And this is kind of a circle of communication for your budget that kind of goes on and on. It doesn't end, it's a circle. So a high functioning and well-run utility is the result of your board making quality decisions about your long-term sustainability, and then having good working relationships with staff that carry out the board's decisions. And part of that process between the board and staff is to develop regular communication, so that they can so that the board and your customer base can remain aware of issues, upcoming projects, and that type of thing before they become crisis level projects. This doesn't mean that you should tell your board everything. It might be controversial to say, but you probably don't need to tell the public everything either. But you do need to be transparent about the important stuff. So overall financial, the big picture, staffing and personnel issues, your legal issues, regulatory concerns, and needed capital improvements, as well as the need for professional contracts. So, with this communication, it can be handled through regular board meetings, and through that process, you just keep a smooth system. So we've got a poll for you. We'd like to know who's responsible for measuring expenses against the budget. And your options are a financial officer or finance officer, utility manager, elected official, a committee, not sure, or other. So you should be seeing the poll.
We have about 60% who have responded, so we're gonna leave it up for about 15 or 20 more seconds. So please get your answers in. Okay, the poll is closing in 3, 2, 1.
And it looks like our results are in that the highest response for who is responsible for measuring expenses against the budget was the finance officer at 52%, followed by the utility manager at 27%. 11% of you were not sure, and then 7% of you responded to committee, and finally 3% of you said elected official. So,
Okay. Well, great. Yeah, that's kind of what we expect to see. It's good that you've got finance officers, people that are used to looking at budgets and calculating these expenses. Okay, so now I'm going to turn it over to Kristen Downs to talk about financial benchmarking.
Thank you, Anna. And are you seeing my screen, or is it not up yet?
Everything looks good, Kristen.
Everything looks good. Okay, great. So as Anna mentioned, I'm Kristen. Now that you've heard about enterprise funds and budgeting, I'll take you through multiple metrics for financial benchmarking. So here are some of the questions you may be asking of yourselves or should be considering. So are any of these keeping you up at night? So first, is your utility or public enterprise self-sufficient? First, this may be a question you get from your governing board or maybe asking yourselves. And self-sufficiency could mean a number of things. We like to use the word viability to describe a standard that a utility should be striving to achieve. One aspect of viability is whether a utility's rate structures and the revenue that are derived from the rate structures are sufficiently addressing the cost of ensuring safe and reliable water. We'll come to this, but we use the metric operating ratio for this idea of self-sufficiency. Second, if your customers stop paying their bills, how long can you maintain your operations before running into a cash problem? This is actually a really good thing to bring up these days because during the pandemic, we saw changes with customer behavior and water use, with many people ending up having to stay home and a lot of businesses and commercial operations shutting down temporarily. And if you're a utility that's providing water services to residential as well as commercial customers, this can certainly have implications on your revenue and water supply. For example, if your town's businesses are shutting down and your residential customers are at home using more water and their bills are going down, but you're not going up, but you're not shutting them off, or you have delinquencies rising, then it's possible that all of a sudden your utility revenues are declining. Similarly, if you're losing commercial customers and some residential customers are behind on paying their bills, you're not able to collect those bills. This creates a revenue reduction problem, which may induce some concern or panic for a utility. However, if you have enough reserves to cover these short-term reductions in revenue, then you're in better shape to weather these cash flow fluctuations. The metric to help you assess whether you're in good condition and how long you're able to pay for operations, even with reduced revenues, is known as days cash on hand. Third, for utilities that do have debt, you know that your debtors will be asking about your principal and interest payments every year. Do you have enough to pay for operations, maintenance, and debt service principal and interest payments? You need to generate enough revenue to at least cover these three things. And we use debt service coverage ratio as a metric for this third question. And finally, we go into asset depreciation, which Anna touched on a little bit. The term asset depreciation refers to an accounting method used to allocate the cost of a tangible or physical asset over its expected or useful life. Depreciation is a budgeting tool that represents how much of an asset's value has been used and allows companies to account for the cost of the infrastructure wearing out every year as a percentage of the value that's set aside. You can also think of this as a savings account towards the replacement cost of the asset plus inflation. Asset management is a little bit more comprehensive understanding of all assets, including their depreciation costs. And as we covered, here are some of the key performance metrics that you can calculate from your audited statements that address each of these questions. And in the following slides, I'll go through each of these metrics to explain how to calculate them. Note that these are just an example of several types of metrics, but there are other additional metrics that you are able to compute. We work a lot with local governments in assessing financial performance, and I know there's not just one metric that will tell you if your system is self-sufficient. So here, I was going to show you a nice video we have on financial benchmarking, but Avery is going to put that in the chat. So I hope that you can take this link and watch it at home. It's around about 10 minutes, but this will give you an overall view of financial benchmarking. And I'm going to go now into the specifics of calculating the metrics that I just mentioned. We have this idea, or this statement called the Comprehensive Annual Financial Report, or CAFR. These are statements on a utility or local government's financial data that are completed every year. You may also know them as yearly audited financials. And they may or may not be audited depending on the process of your audits. But these provide financial data necessary to calculate financial indicators on the dashboard. We know sometimes utilities may not look or may not use or look at these statements in a way to glean key performance indicators from them or track their financial performance. However, it's possible to be proactive and use this data that's collected and reported on the statements in order to track performance over time. For non-local government utilities, financial statements aren't created in the same way, but there are equivalents like balance sheets, shareholder reports, or annual reports that are submitted to utilities commissions or public service commissions that could provide a source of this financial data. So, poll for you. Do you have yearly audited financial statements? The options are yes, I do, and I read them every year. Yes, and I don't read them every year. No, or not sure. So go ahead and take some time to answer this question.
About 50% have responded, so we're going to leave it up for at least 20 to 25 more seconds. Okay, the poll is going to close in 3, 2, 1.
Okay, so it looks like 38% of you have responded yes, and that you read them every year. 13% yes, but you don't read them every year. 24% said no, you don't have yearly audited financial statements, and then 25% are not sure.
Great, that's good to hear your feedback. So for those of you that do have audited financial statements, this is a great source of data. And For those of you who aren't sure, maybe this is something you could find out, and who don't have audited financial statements, and that's relevant to you if you work for a utility, maybe that's something you could find out more about. So why do we care about financial benchmarks? They're beneficial for multiple reasons. They provide a holistic picture of a utility's performance and needs. They're informative for future goals and growth, as well as capital planning. They provide information on customer affordability, and it can inform decisions on financing options. So now we'll return to the 4 financial benchmarking metrics that I mentioned earlier. So first, we'll start with the operating ratio, which is one of the most common metrics and is a measure of self-sufficiency. You can calculate the operation ratio by dividing the total operating expenses by the total operating, total operating revenues by total operating expenses, as you can see in the equation. Total operating revenues for water and wastewater enterprise funds typically means your water and sewer charges. These include your rates, your late fees, your penalties, your connection fees, tap fees, all the rates, fees, and charges basically that customers are directly charged go into the total operating revenues. Now the denominator is the total operating expenses, which includes all expenses and expenditures you have for operations and maintenance. This can include supplies, salaries, benefits, overtime, and if you pay any taxes or insurance, that would be included too. Basically, any all day-to-day or year-to-year expenses are included, as well as depreciation. Now, operating expenses for a given fiscal year do not include debt service costs or any kind of reserves that you may be building up for future capital projects. In other words, they exclude future capital expenses. Now, and if you calculate and look at your operating ratio, you'll know that you want to keep the operating ratio at least exceeding the operating expenses. You'll want to make sure your revenue exceeds your expenses in any given year. So we're looking for a ratio of at least 1.0. Now, there is this thing I'm sure you've heard of called depreciation, which is an accounting solution to the problem of things getting old, where you have a cost every year that you account for of your infrastructure wearing out as a percentage of its value. There are 2 different ways that you can calculate the operating ratio, depending whether or not you include depreciation. When you calculate operating ratio with depreciation, you divide the total operating revenues by total depreciation, which will include depreciation. Total operating revenues by total operating expenses, and that'll include the depreciation by default. When you calculate this, you're have an understanding of whether you had enough revenues to pay for O&M and put enough aside to pay for assets that are depreciating in value and physical condition. However, if you exclude depreciation from your operating ratio, you'll take the value of depreciation from the denominator, and this changes the definition of OR. From this calculation, you're only asking whether or not the revenues coming in were enough to pay for your operations and maintenance costs. And these are 2 very important and distinct ways of calculating the operating ratio. If your utility is budgeting for future expenses and you have a capital improvement plan and know very well what your comprehensive needs are going to, then it's a good idea to be budgeting for O&M and all the capital investments you're expecting to be paying for. If you don't do that and you don't have a capital improvement plan or an asset management plan, then you should at least be trying to budget for depreciation. In that way, you're generating enough revenues to save for the replacement of some of the assets that you have. And you want to have an operating ratio to be above 1. I'd actually argue that you want it above 1.1 or 1.2, so that when you're depreciating assets, you're depreciating them on past purchase prices. Generally, when you're depreciating assets, you account for past purchase prices. But as you know, when you try to replace a pipe that you put in 30 years ago today, it's likely to be a lot more expensive than it was when you first purchased it. So even when you're meeting your O&M expenses and your depreciation, you may not have enough to pay for the actual replacement of your assets going forward. So aim for a higher ratio like 1.1 or 1.2 as a better target. And if you're looking for a good ratio without depreciation, you'll want to set a target that's much higher than 1, because it doesn't include anything regarding capital at all, whether that's debt service or future capital investments. And it's just looking at O&M. Oh, want to note that the definition by the National Association of Clean Water Agencies excludes depreciation, and you can choose, again, which you'd like to use. So now we're going to imagine a fictional town of Mayberry and look at its CAFRs, or audited financials, to calculate some of these metrics. And so I want to draw your attention to 1, 2, and 3, the total operating revenues marked with 1, the total operating expenses 2, and depreciation. So for example, in calculating the operating ratio for Mayberry, we'll take the operating revenues in the numerator, about 444,000, divide that by our operating expenses, which include depreciation, about 500,000, and we'll end up with a operating ratio of 0.87. And looking at the revenues and expenses, we see that in order for it to be 1, we would need to increase the revenue to 511,000, the same as the expenses. And we could either increase the revenue or try to decrease costs. But if we know we need to generate about $67,000 more dollars, then that can guide conversations about rate increases. Now, if you think about wanting to have an OR over 1, how would you calculate that? You could pick a target OR as your answer and then solve for the operating revenue needed in your denominator. Now, if we look at operating ratio excluding depreciation, we're going to go back to those same values, the operating revenues, operating expenses, and now include depreciation number 3. So the numerator is the same as before. Now, and this time we subtract 142,000 of depreciation from the operating expenses, and you can see our denominator decreases substantially, and our operating ratio increases to 1.2, which is above 1. Our second metric is debt service coverage ratio. And this is for those of you with debt service, since you'll need to be able to generate enough revenues in a year to pay for O&M and the principal and interest payments for the debt service. So that's your revenues in each year need to exceed this total sum. Debt service coverage ratio is calculated by funders and debtors and is a very common metric in the finance world. To calculate this, you take the operating revenues, subtract out all of the operating expenditures, excluding depreciation, and divide it by the principal and interest payments on the long-term debt. For Mayberry, we're going to use the 3 values from earlier: operating expenses, operating revenues, and depreciation, and add in information relevant to debt service, which is shown here on number 4, which is the principal paid on the capital debt as well as the interest paid. And depending on how your financials are set up, these may be on the same line or on separate lines. So for Mayberry, we're reusing a lot of the same numbers as before, taking operating revenues, subtracting out operating expenses, excluding depreciation, and dividing that by the sum of principal and interest on long-term debt. And you can see that that gives us a debt service coverage ratio of 0.89. You might think that a target of 1 is a good aim, but for debt service, bond covenants and funding agencies will require you to generate a little bit of a higher ratio than 1, often something like 1.1 or 1.2, because funders want to make sure you have enough security and enough revenue each year that it covers not only the principal and interest in O&M, but that you're also generating additional revenue for future years when there might be some revenue reduction. So this is a good idea to check your bond covenant for their requirements, because that's the number that you will need to be trying to achieve. Our third metric is days cash on hand, which gives you an idea of how long you can continue to pay for O&M without any additional revenues coming in. You can think of it as like, what can you do under an emergency? And at the very least, you want it enough to last a billing cycle or when you expect a substantial inflow of cash. In other words, how much is there in reserve that that you have that can pay for your operations and maintenance costs at any time, especially when there is an event that causes significant temporary reduction in revenue. In order to calculate days cash on hand, you need to know what your unrestricted cash and cash equivalents are. This includes what you have in the bank that is not being restricted for use for some other purpose. Note that some of the cash in the bank for enterprise funds might be restricted through bond covenants to pay for principal and interest or to reserve a security for your debt. You might even have a cap reserve fund that puts some of these funds aside and reserves them just for capital projects. You can't dip into these restricted funds to pay for O&M, but you can only use them for their specific purposes. So you need to find your financial statements and what's listed as unrestricted cash, which is money in the enterprise fund that can be used for anything. You can take the value of unrestricted cash and cash equivalents and divide it by the average daily O&M costs, excluding depreciation, dividing by 365 days a year. And you can see in this equation, because you're dividing by the average over 365, based on how the math works out, you see multiplying by 365 days in the numerator. So overall, this gives you the ratio, that's the days of cash on hand to pay for O&M costs. So going back to our financials, we're focusing right now on the cash in number 5. And for our final metric, we'll look at the receivables. So here we take operating expenses minus depreciation, divided by 365 days. In the numerator, we'll take the unrestricted cash and cash equivalents, about 107 or 108,000. That was in number 5. And we'll end up with days of cash on hand for Mayberry of 107 days to operate from the reserves. Now, a question you might ask is, what's a good target for days cash on hand? There's no one specific target that suits everyone's needs, but it's important to also think about an event like the pandemic, where some utilities may have seen revenue reduction from businesses shutting down operations or delinquencies piling up amongst residential customers. If you run out of your unrestricted cash funds within the time frame of a few months, then your days cash on hand may not have been enough of a security for you to weather a longer term condition like what we faced. So days cash on hand is a good way to assess how long a utility can continue to operate under an emergency situation. Finally, I'll talk again about asset depreciation. So for this, I'll mention that there is you can assess that there are different ways to think about assets and depreciation. When you want to assess the physical condition of your assets through audited statements and through depreciation values. However, this is tricky because the accounting information may not really match the physical reality. What I mean is that when you're looking at depreciation, who sets depreciation values? Usually this is the finance department or accountants. But when you're talking about the physical assets themselves, things might be physically depreciating at a different rate than how they're depreciating on paper through the audited statements. For example, accountants might say that we're going to take a pipe and depreciate the asset set. You know, each pipe lasts about 50 years and can assume a linear depreciation such that it depreciates the same amount every year until 50 years. However, if you're working in utility or you work with pipes, you know that when running systems, one pipe is not the same as another pipe. Not every pipe will depreciate linearly over time, and it can be really difficult to estimate the actual length of time a given pipe or asset might last. So, as you know, the physical condition may not match financial depreciation. However, we can get an idea quickly of assessing whether your assets are overall depreciating faster than you're able to invest in the rehabilitation or recovery by calculating asset depreciation. And this looks at the accumulated depreciation divided by the gross value of the assets that you have that are depreciable. The big takeaway is you don't want to get close to 1. So based on this ratio, it can range from 0 to 100% or 0 to 1. When you're at 1 or 100%, then you financially depreciated all of your assets, which is a really bad sign. And when you're close to 0, you have a brand new system that you've just put in place this year, and the assets haven't started to depreciate yet. So as you can imagine, everyone's usually somewhere between 0 and 100%. And this metric can be, when you're thinking about a benchmark, it's preferable to be lower rather than higher. But whether, let's say, 30 or 40% or 0.3 or 0.4 is good or bad is a subjective call. Finally, I want to mention to you all that we have a financial health checkup tool, which the link is now in your chat. And I encourage you all to visit this. This tool is an Excel-based tool that's free, and you can use it to input financial information based on your 5 years of financial audits, and it will calculate the different ratios and metrics that we've discussed in this presentation. So you can see where you stand and use it as benchmarks going forward. Please go visit our checkup tool and contact us at the UNC Environmental Finance Center if you have any questions. So I want to, on behalf of Anna and I, we want to thank you for coming to our presentation on financial benchmarking, and with the remaining time, we can take questions.
Thank you both so much for presenting today. It looks like we don't have any questions at the moment, but we can hang around a few minutes if any pop in. And if you have any questions after the fact when you're reviewing the recording or the slides, feel free to email Anna or Kristen directly, or you can contact us at our smallsystems@syr.edu email as well, and we'll direct your questions to them. And while we're waiting for questions to come in, I just want to let you all know that we will be sending out a follow-up email within the next couple of days, probably extending into early next week, with the slides from today, as well as a link to the recording, as well as the financial checkup tool and the financial benchmarking video. We're sorry we weren't able to share that today, but we really encourage you to view it on your own time. So be on the lookout for those. And I'm not seeing any questions, but we're getting some comments. So they're saying, very helpful information. And it looks like it's an attendee appreciated the walkthrough of the formulas with the sample data. So it sounds like that was very helpful. Yeah, if there aren't any questions, then I think we can go ahead and wrap up a few minutes early. So again, thank you, Anna and Kristen, for sharing your expertise with us today. And lastly, we also ask that you would complete our evaluation following this webinar, so you can let us know your thoughts on today's session, as this helps us plan future webinars on topics important to you. And this will pop up automatically following the webinar. And thank you again. And Anna and Kristen, do you have any last remarks for our audience today?
Thank you for attending. We really appreciate it.
Thank you.